Hey everyone, me Kevin here. Oh dear, oh dear, oh dear. The new productivity numbers from the Federal Reserve were published today for labor productivity, and folks, deep breath because they were not good. This is where you want to make sure you have life insurance that you can get in as little as 5 minutes by going to mettkevin.com/life. Folks, look. The Federal Reserve has consistently been promising that don't worry, yes, wages are going up, but worker productivity is also going up. So as long as worker productivity goes up with wage growth, then we're less likely to see the wage price spiral lead to more inflation. Let me clarify that going in the opposite direction. If wages go up, so it now costs you $15 an hour to flip hamburgers instead of $10 an hour, then the price of that hamburger has to go up unless the person flipping burgers for $15 can flip 50% more burgers than the person working for $10 an hour. That would be productivity going up with wage cost, and you actually have an equilibrium to where you have a net zero effect on inflation. But if you have to pay $15, but you're flipping the same amount of burgers as the $10 burger flipper, well, then the price of the burger either goes up or the margin, the profit margin of the company goes down, which the company's always going to try to share some of margin loss with the consumer, which means the consumer will eventually pay at least 50% of the burden, if not more, if not completely all of it. Since, again, that's what businesses do. They pass along consumer cost to customers to maintain margins. It's very important. And then you have inflation. And so far, the thesis has been, hey, don't worry. Productivity is going up. We don't need to be worried so much about wage price inflation because as long as productivity goes up, we're good. Unfortunately, the latest numbers do not look good. The Federal Reserve found that non-farm worker productivity in quarter 3, and these months are very important, remember these, July, August, and September, fell 5% at an annualized rate. That is the largest decrease in worker productivity that we've had since 1981. That's 40 years. The largest decrease in annualized and quarter over quarter worker productivity that we have had in 40 years. At the same time, Q3 wages jumped by 1.5% in just the quarter. From where, that's like a 6% annualized rate, right? From where we were a year ago, wages and incentives grew 4.6%. Wages excluding perks grew 4% compared to a year ago. And some companies like Tesla and Chipotle have raised prices to manage higher wage costs. And it's not just Tesla and Chipotle, it's almost all companies are raising prices. So when you bring this together, it's like, wait a minute, these both indicate the potential for more inflation lasting longer, which is not good. Now, the increase in wages itself isn't as scary. It's when you pair it with low productivity. And that's what we just got in this last report. Now, we have to think logically here because the emotional reaction is to say, that's it. The market crash is coming. Inflation is out of control, which in fairness it is. Jerome Powell literally yesterday used the words to get inflation under control, which means it's out of control, right? It's the first time he's uttered those words. And transitory inflation has now turned into eventually transitory inflation, right? But anyway, which we kind of predicted that the Fed would kind of change their tune in that direction, and they did. But anyway, we have to use logic and reason to dig into this. Why would productivity go down in Q3? Ask yourself this. Why could possibly productivity go down in Q3 when companies keep talking about worker productivity going up? Kathy Wood at ARK Invest talks about productivity going up. So why is productivity going down in this report? Well, in my opinion, it could potentially have to do with the fact that in Q3, we had a substantial increase of COVID cases. Think about this. In Q2, which is April, May, June, nobody was really worried about the Delta variant. Nobody was really worried about the Delta variant until the end of July. So Q2 was April, May, June. In April, May, June, worker productivity increased by 2.4% at an annualized rate. Then the Delta variant comes around and we lose worker productivity by about twice that towards the negative, 5% at an annualized rate. But in Q3, we also saw COVID cases skyrocket. Take a look at this. Daily new COVID cases per million people. What do you see? These are the 7-day average lines here. The US is the light blue line here. You see our winter spike right here, but take a look at exactly where this spike was. Folks, literally smack dab Q2. July, August, September, and by the time you get to October, it's basically already back down to, April lows. So or this being Q3, right? So Q3 got devastated by a surge in Delta cases and a lot of fear. The increase in cases likely resulted, and we saw this, in more restrictions and precautions, more mask wearing, more COVID testing, more screening, more sick days. And guess what happens when people spend time at home? They have to go get COVID tested. They have to go get their vaccines. They have to, get their masks or wear their masks or deal with all this crap, right? Or spend time even worrying about it. Well, obviously then that's time you're not spending on being a productive worker. And so my best estimate here is that this fall in worker productivity is not necessarily a sign of a potential market crash coming or market collapse. It is really a symptom of the Delta variant. And so this means we're actually in this market still getting crappy data from Q3 thanks to Delta. But right now, it actually doesn't look like we are going into any kind of COVID winter again. Please, knock on wood, that we do not see a COVID winter again. That would be very, very bad, okay? I want to keep the stethoscope away. Although it's kind of cool. It's like abalone. Oops. You can't really see it, though, I don't think. Oh yeah, now you can. Look at that. Ooh, that's nice. That's nice. I paid good money for this because, stock doctor. But anyway, it's also worth noting that hours worked increased at a 7% rate last quarter. That's up from 5.9% the pace logged in the second quarter. So far, this hasn't really been an issue of salaried employees working less. We're actually working more. It's actually that productivity has just gone down, and we really think this is potentially because of COVID. Now, if this trend continues and we have bad productivity in Q3, that's going to be bad. That's going to be bad for inflation, and it's going to be very bullish for crypto. I am bullish on crypto for about the next 9 months because I do believe that once inflation inflects down, there are going to be some risks to cryptocurrencies. But until then, I think there are way more positive catalysts than negative catalysts. I am also, again, happy to say, since some of you know that I was on margin, again, for a brief period of time, I am out of margin again. So I'm very happy about that, and am building up some positions again where I did a little bit of trimming. So, and of course, if you ever want to know all of my buy and sells, everything that I'm doing, not meant to be copied, just meant to give you an idea of where I'm looking for deals or opportunities, check the program's link down below on Building Your Wealth. But am I just speculating that COVID was the issue? Well, it's worth noting this. JP Morgan released a set of business surveys, and they found that business momentum actually bottomed in Q3 in August. Which is really interesting because, again, if business momentum bottomed in August and we're up from there, then again, that potentially reiterates that this was all COVID-based. This is a little hard to see, but basically what you want to look at is, see the 20 at the bottom and that massive fall off the chart? Yeah, look to the right of that. Look more kind of where that blue line is going up again under that orange line. And that little bottom that we see right there, the summer was really productive. That's the PMI, the Producer and Product Manufacturing Index. This is good, Producers Manufacturing Index. This is good. But we bottomed out there in August, and we could already see in September and October that inflection up. And so this is a report here, again, by JP Morgan, showing that we essentially bottomed in terms of slowing momentum. Which is very good. we got that behind us. So this is just another example and a little bit more evidence to reiterate that, yeah, this is probably all COVID related. I hope so, but it's a warning that we want to be careful of anyway. Tomorrow, we got big jobs data. Let's talk briefly about jobs data because we've got some big expectations for tomorrow. In fact, I'm going to pull up the economic calendar and the projections for tomorrow. So tomorrow we have non-farm payrolls, and private payrolls, manufacturing payrolls. We got a lot of things. What we're expecting is the unemployment rate to go from 4.8% down to 4.7%. We are expecting average hourly earnings to, instead of being up 0.6% like they were last month, to be up 0.4%. That would be an annualized inflation rate of 4.8% in wages. We are expecting the total figure of non-farm payrolls to come in at 450,000. And that is compared to the prior release of 194,000, which was a complete disaster. We are expecting the labor force participation rate to rise 0.1%, so 0.1%, to 61.7, which is still a pretty low number. And then we do next Wednesday get CPI data. We're actually expecting a high headline read of 5.8%. So tomorrow, my expectation is, and it's worth seeing the labor force participation rate as well. I'll show you this in just 1 second. But it's worth noting that tomorrow, when we get this jobs report, if we get a number that comes in above 700,000 jobs, I think that's going to be bullish for the economy picking up and potentially more tapering, the pace of tapering continuing or even perhaps accelerating. I think if we get a low read like we did last month because of the September jobs report, we could end up with something like 200,000 jobs again. That's not going to be good. That might actually lead the Fed to slow down their taper a little bit, which usually if the numbers come in too hot, tech stocks fall because people are worried about like overheating and then interest rates going up sooner. And it used to be that if the jobs numbers came in too low, then that was good because that would mean that more cheap money would be coming our way and tech stocks would go up. But that's recently changed to where the market's almost kind of wanting rates to go up a little bit to quell inflation since it is lasting longer. And so I would argue probably good news might actually be good news tomorrow. And if we could just like meet expectations, that'd probably be the best case scenario. Just keep away from the extremes to both sides. That would be my expectation. No guarantees, obviously. Now, it's also worth looking at the labor force participation chart, since you may not have seen this before. This is the labor force participation chart, It's from Bloomberg. Thank you, Bloomberg. It is showing the surveyed read in the purple line and the actual read in the blue line. So you can see we used to be at labor force participation handsomely here around, this would be like 2015, 16, 17, 18, pretty much regularly around 62.5 to 63.5%. And we've really plummeted to 61.5. So it doesn't seem like that much when you just read, labor force participation's down 2%. But 2%'s a lot. Because remember, if you have a workforce of 150 million people, 2% is 3 million people, right? 2%, there we go. That's 3 million people. 3 million people is literally like an extra 250,000 jobs every single month for a year. So that labor force participation number matters a lot. It feels insignificant, but it actually matters a lot. So we'll see if we get a beat on that. We'll see what happens with the inflation numbers. So far, 10-year Treasury yields are actually falling, and that's possibly because the Bank of England, who was widely expected to raise interest rates, decided not to raise interest rates, which was a real big shocker this morning. In fact, the 10-year Treasury right now, take a look at it here. 10-year Treasury sitting at 1.53. We, in April, ran up to about 1.75. Recently, we ran to about 1.69, 1.7. It's come down a good chunk, especially after that UK surprise, or I should say Bank of England surprise. So a little bit of a shocker there. But we could continue to see, look at this. 10-year Treasury yield falls as investors digest Fed decision as well. We could potentially see yields actually continue to rotate down, ironically, as maybe we expect a recovery to be slower, inflation to be a little bit longer lasting, but not to the point of hyperinflation to where the bond market is indicating any real signs of concern. The bond market seems to be pretty happy with where it is, which is below historic levels right now anyway. In fact, you could just click on the 10-year and then just go out to the 5-year and you could see how we're below historic levels. Worth noting that at the end of 2019, we did sit around the 1.8 to 1.9 range. So again, at 1.53, we're still decently below where we have been. So we're expecting less inflation in the bond market now than we did even before the pandemic. Kind of worth noting. Not that the 10-year Treasury bond is the perfect measure of inflation anyway. I think a better one to look at would be the 10-year break even, which you can look up by just typing into Google St. Louis Fred. St. Louis Fed's 10-year break even. This takes the difference between the tips and the 10-year, which this would show a little bit higher of an inflation expectation. This is the better way to say it. In here, it makes more sense, right? That we're expecting more inflation than we had before the pandemic. That makes more intuitive sense, right? So there's more here at play. And because you're seeing such a discounting in tips, as more people buy it, the yield continues to go down on it because the demand for Treasury insured and protected securities is going up. Demand goes up, price goes up, yield goes down. And as yield goes down on the tips because more people are buying it and the 10-year Treasury goes up, you get this widening, and that widening is measured by the 10-year break-even inflation rate. It's just it's literally the difference between the 10-year rate and the tips. Which the tips is negative right now. That's why the reading is 2.56, because you're like negative 1% on tips. But anyway, it does show you that inflation expectations are indeed higher now than they were before. So I'm glad we moved on to sort of the 10-year break even rather than just the 10-year. But the point is, nonetheless, the 10-year is down from 2019. People are not jumping up and down for dumping the Treasury bonds, because if folks were expecting high inflation, like really expecting high inflation, we would expect people to say, why would I have a 10-year Treasury bond that's going to pay me 1.53%? Let me dump that and sell it. When you sell it, the price of bonds goes down. More selling pressure means price goes down, and then yield goes up. But we're not really seeing these get dumped. So you really see that debate and that massive argument we have in the market right now on inflation. But anyway, tomorrow's going to be a big tell. Productivity numbers were a disappointment, but probably because of COVID. And then we have expectations that we went through for job numbers tomorrow, which will be very interesting to pay attention to. I expect to be awake at 5:30 a.m. to cover them. Hopefully Anyway, thank you so much for watching the video, and folks, we'll see you in the next one. Goodbye.